Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Destiny Tech 100.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And today we have a really fascinating analysis for you. We are looking into a sector of the financial world that has historically just operated behind completely locked doors. The private technology market.
Right, because for decades now, the most staggering exponential growth in the tech sector has occurred long before a company ever rings the bell at the New York Stock Exchange.
Exactly.
But today we are analyzing a specific financial instrument that is attempting to alter those mechanics entirely. We are looking under the hood of Destiny Tech 100.
It's a profound shift in market access. To understand how this mechanism operates, we've pulled from a robust stack of recent financial performance data. We're talking highly detailed regulatory filings like their 2025 semi-annual report and the monthly portfolio updates.
And we're cross-referencing all of that with the latest market news feeds.
Right. The goal here is to see not just what they hold, but how the broader market is currently pricing those holdings.
And the mission for this talk is to clarify exactly how this fund is engineered. If you're out there tracking the wealth-building landscape, the gap between public and private market returns has been a glaring issue.
Oh, absolutely. It's massive.
So we are going to examine how Destiny Tech 100 attempts to act as a conduit for retail capital into these venture-backed tech unicorns. We'll look at the catalyst behind its recent outsized market buzz.
And the structural risks. Because those are inherent in this model.
Yeah, we have to talk about the risks.
That structural aspect is really the cornerstone of the whole conversation today. Because to understand the recent price action, which has been, honestly, significant, we first have to interrogate the actual architecture of the fund itself.
So let's break down those mechanics. When you look at Destiny Tech 100, it is categorized as a closed-end management investment company. So for anyone attempting to run a standard fundamental analysis, the usual metrics are just completely useless.
Throw them out.
Yeah, you won't find traditional revenue figures. And hunting for an EPS in their filings is basically a fool's errand.
It requires a completely different analytical framework. The underlying value here isn't driven by selling a product to a consumer. It is driven exclusively by its net asset value, or NAV.
The NAV.
Right. The NAV represents the aggregate estimated value of all the private company shares held within the portfolio. However, and this is crucial to establish right away for you listening, because it's a closed-end fund trading on a public exchange, its share price is dictated by open market supply and demand.
Which means the stock price can wildly decouple from that underlying net asset value.
Precisely. Unlike a traditional exchange-traded product that has creation and redemption mechanisms to keep the share price pinned closely to its NAV, a closed-end fund has a fixed number of shares.
It's a fixed pool.
So if retail demand surges, if there is immense FOMO for the private assets they hold, the stock can trade at a staggering premium to its actual NAV.
But conversely, if sentiment sours, it can trade at a steep discount.
Exactly. That dynamic introduces a layer of volatility that goes far beyond just the performance of the underlying startups themselves.
That volatility is a critical piece of the puzzle, and we will definitely dig into the recent return data to illustrate that later on. But first, let's look at the assets actually driving that NAV.
Let's do it.
Destiny Tech 100 structural mandate is to invest at least 80% of its assets in rapidly growing venture-backed technology companies.
And they are utilizing an asset-light strategy. They are heavily concentrated in software and platform-based holdings.
But I want to push back on that just a bit. Concentrating so heavily on software, isn't that just the standard venture capital playbook? Doesn't that over-concentrate their risk if we see a macro contraction in enterprise software spending?
It certainly introduces sector-specific risk, but the rationale really comes down to the unit economics. Software and platform models possess incredibly low marginal costs.
Right.
Scaling a platform from 10,000 users to 10 million users doesn't require building new factories or untangling complex physical supply chains.
You just spin up more servers.
Exactly. The institutional argument is that this frictionless scalability is really the only way to reliably generate the multi-bagger returns necessary to offset the inherent failure rate of venture capital.
And to put this into perspective regarding retail access, because this is huge for you listening, for decades, the regulatory accredited investor rules have functioned like a velvet rope at an exclusive club.
A very exclusive club.
Unless you had a massive net worth or a very high sustained income, you simply weren't allowed inside the private equity markets. You had to wait outside until the IPO.
Which is when all the major growth has already happened.
Yeah, exactly. Destiny Tech 100 is effectively acting as the bouncer, letting retail capital in through the side door. It mirrors the convenience of a broad market tech index, but strictly for the private market.
The historical context there is so important to understand. If you look at a company like Amazon, it went public in 1997 at a valuation of under $500 million.
$500 million. That's tiny by today's standards.
Right, and everyday investors could capture decades of hypergrowth from that point forward. But today, the most successful tech companies are staying private much, much longer.
Yeah, they are raising billions in private markets.
And only going public when their valuations are already in the tens or hundreds of billions.
So the retail investor is missing the most explosive phase of the growth curve entirely.
Precisely. Destiny Tech 100 is engineered specifically to bridge that gap.
And the filings are highly specific about the maturity of the companies they are targeting. They aren't seeding early-stage ideas in a garage.
No, definitely not.
They are focused on medium-cap unicorns, which they define as companies valued between $750 million to $10 billion, and large-cap unicorns valued over $10 billion.
That scale significantly alters the risk profile compared to a traditional early-stage venture fund. By the time a company reaches a $10 billion valuation in the private market, they have thoroughly de-risked their product market fit.
They possess substantial revenue streams.
Entrenched market positions. The risk really shifts from, will this product work, to, can this valuation be justified upon an eventual liquidity event?
Which brings us to the catalysts that actually make the market pay the premium we discussed earlier. According to the latest market context, as of January 28, 2026, shares of Destiny Tech 100 experienced a profound breakout.
A massive session.
They jumped 15.05% in a single day, closing at $34.10.
That kind of sustained intraday momentum is rarely arbitrary. The extended trading gains were directly catalyzed by a portfolio update hitting the wire.
The Anthropic news.
Yes. Destiny Tech 100 officially added exposure to Anthropic.
And Anthropic is not just another wrapper built on top of an existing language model. Their Claude models are actively going toe-to-toe with OpenAI's GPT-4 across all the major enterprise benchmarks.
It's top-tier tech.
So the moment the retail market recognized a publicly traded asset offering direct exposure to Anthropic, the volume just flooded in.
It really highlights how artificial intelligence is currently functioning as the ultimate market catalyst right now. But what is strategically significant here is that the fund isn't just arriving late to the AI narrative.
No, they've been in it.
Right. If we look at the historical regulatory filings, they have held exposure to OpenAI since January 2024.
Structured via their specific OpenAI holding entity.
Exactly. So by adding Anthropic to a portfolio that already holds OpenAI, they are essentially taking a dual monopoly bet on the foundational layer of the future AI economy.
That dual exposure is fascinating. And it's worth interrogating how they manage the capital within this structure.
Yeah.
Because they don't pay out dividends.
No.
They don't execute share buybacks. The capital is aggressively retained and reinvested into new private positions.
Which is the exact optimal strategy for this specific asset class. In the public equity markets, you might look for a dividend yield to mitigate risk. But in the private venture space, extracting cash completely disrupts the compounding machine.
You want that money working.
The entire thesis relies on the compound effect of capital being continuously deployed into the next Anthropic or the next OpenAI. Any capital distributed as a dividend would just be subject to immediate taxation, defeating the whole purpose of a multi-year growth vehicle.
We can see that institutional capital agrees with that methodology too. The ownership data we pulled shows notable alignment. The Destiny management entity itself retains a 6.453% stake in the fund.
Insider alignment of that magnitude is a very strong signal. But perhaps more interesting are the external institutional accumulations we saw.
Like Commonwealth Equity.
Right. The filings show Commonwealth Equity holding a 0.54% stake, and Morgan Stanley taking a 0.41% stake.
Now that makes sense in a bull market, but let's pause on that for a second. Why would a massive entity like Morgan Stanley, which has its own elite private wealth management divisions and direct access to venture deal flow, bother taking a position in a retail-facing closed-end fund?
It really comes down to liquidity and administrative efficiency.
Oh, so?
Well, even for a giant like Morgan Stanley, sourcing direct secondary shares of a heavily guarded unicorn like Anthropic requires navigating incredibly complex legal frameworks.
Right, the right of first refusal clauses.
Exactly, and illiquidity lockups. Destiny Tech 100 has already done the heavy lifting of building those institutional pathways.
They did the hard part.
Yes. For a wealth manager looking to quickly allocate client funds into a basket of late-stage private tech without the administrative nightmare of direct secondary market purchases, this fund serves as a highly efficient liquid proxy.
So we have the AI sector acting as a massive tailwind. But the quantitative sentiment scoring in our analysis is currently flashing a bright green bullish, and a significant portion of that sentiment isn't even driven by generative AI.
No, it's the space economy.
Let's examine this SpaceX fever, currently dominating the news feeds and pulling other assets along with it.
The macro market psychology here is heavily skewed toward the private space sector right now, and the financials leaking out regarding SpaceX are genuinely staggering.
Mind-blowing numbers.
We are looking at an enterprise reportedly generating between $15 and $16 billion in top-line revenue.
Let's just contextualize that for the listener. A private venture-backed aerospace company generating $16 billion in revenue is almost unprecedented.
And what's more impressive is the reported $8 billion in EBITDA.
Right.
This proves they have transitioned away from being a cash-burning exploratory startup into a highly optimized profitability engine, and the underlying catalyst driving those margins is that 50 to 80% of that revenue is sourced directly from Starlink.
Starlink is a fascinating piece of this puzzle, because they aren't just launching rockets. They are rapidly constructing a low Earth orbit telecommunications monopoly.
Yes, they are.
Traditional telecom companies have to lay thousands of miles of expensive fiber optic cable just to expand their footprint. Starlink bypasses terrestrial infrastructure entirely.
Which brings us to the speculative catalyst setting the broader market on fire right now. The current, albeit unconfirmed market rumor points toward a potential June 2026 SpaceX IPO.
The big one.
And the numbers attached to this rumor are what's driving the hype. A $50 billion capital raise at a $1.5 trillion valuation.
$1.5 trillion valuation for a company that hasn't even hit the public markets yet. It's hard to overstate how disruptive that is to traditional financial modeling. But if you are looking at this from a retail perspective, how does a SpaceX IPO rumor specifically benefit Destiny Tech 100? Because it isn't just a pure play space fund.
It benefits them through the mechanics of a macro sector rotation.
Explain that.
When the broader financial media gets whipped into a frenzy over a $1.5 trillion private tech valuation, institutional and retail capital alike begin scrambling for proxy exposure to the broader private market ecosystem.
A rising tide lifts all boats.
Exactly. The sheer gravity of a liquidity event that large forces analysts to re-rate the entire late-stage private tech sector. Even if Destiny Tech 100 isn't exclusively a SpaceX proxy, the rising tide of private market enthusiasm inevitably lifts the valuation models and the share prices of funds providing access to that space.
It really validates the core thesis of the fund, that the most valuable companies in the world are choosing to stay private longer, capturing the steepest part of their growth curve away from the public eye.
Exactly. It proves the private market is no longer just a waiting room for the public exchanges. It has become the primary destination for serious wealth creation.
The narrative we've built so far is undeniably compelling. We have an 8 out of 10 bullish score in the quantitative analysis we looked at. We've got exposure to foundational AI models like Anthropic and OpenAI, and the halo effect of an impending mega-cap space IPO.
It looks great on paper.
But let's introduce some friction into this thesis. It is vital to examine the downside because the structural risks of this vehicle are substantial. Let's get the bear case.
The most immediate risk brings us right back to the beginning of our discussion. The inherent volatility of a closed-end fund trading on a public exchange.
Right, to the premium.
Because the share price is driven by retail sentiment rather than just the underlying NAV the premium investors are willing to pay can evaporate overnight.
And we have a stark data point from the market data that illustrates this perfectly. We aren't just dealing with hypotheticals here. The recent data shows a one-year return of negative 26.29%.
That's a massive drop.
If you are holding an index fund, a 26% drop usually means a global recession. For Destiny Tech 100, it just means the premium collapsed.
That negative return is a very sobering reminder of how illiquidity amplifies downside risk.
Hmm.
When you hold private unicorn stock, you cannot simply liquidate $100 million of Anthropic shares on a random Tuesday afternoon to raise capital or meet redemptions.
The buyers just aren't there like they are for Apple or Microsoft.
Right, the pricing of these assets is inherently imprecise until a true liquidity event occurs, like an acquisition or an IPO. If the market suddenly decides it doesn't want to pay a 40% premium for access to those illiquid assets, the stock price will plummet, even if the underlying companies are still performing perfectly well.
Which ties directly into the risk of hype fade. While the overall analysis sits at an 8 out of 10 bullish, several specific market sentiment indicators we reviewed score a flat 0, completely neutral.
Sentiment is a highly perishable commodity. Consider that SpaceX IPO rumor. It is currently acting as a massive tailwind.
But what happens if Elon Musk delays that IPO to 2027?
Or what happens if the broader market experiences a slight tech correction and the appetite for AI startups just cools off?
The current hype supporting that recent 15% surge could dissipate rapidly.
When you are buying a fund based heavily on momentum and exclusive access, a shift in market psychology is just as dangerous as a fundamental flaw in the portfolio.
So the obvious question for you listening is, how does the fund's management actually mitigate that? They can't dictate the IPO timelines of their holdings, and they certainly can't control the whims of retail market psychology.
The primary mitigation strategy revolves around strict internal governance and strategic structural flexibility. First, the fund is overseen by an investment committee that mandates independent valuation oversight.
Meaning they don't just let the portfolio managers grade their own homework.
Exactly. They utilize third-party valuation firms to assess the worth of their private holdings. This is critical for investor protection because it ensures that the stated net asset value, which is the fundamental anchor of the fund, is as objective and mathematically sound as possible.
Rather than being inflated by internal optimism.
Right.
And what about the illiquidity problem? If the private IPO window slams shut, how do they navigate that?
This is where their mandate provides a crucial shock absorber. While their primary objective is acquiring late-stage private unicorns, the fund's structure actually allows for opportunistic investments in highly liquid, publicly traded technology stocks.
Okay, so they could pivot.
Yes. If the private markets freeze up, or if secondary market pricing becomes irrational, they have the flexibility to pivot capital into public equities. That provides stability and maintains a degree of liquidity within the broader portfolio.
So let's pull all of these threads together. If we synthesize the regulatory filings, the financial metrics, the structural mechanics of the closed-end model, and the current catalysts driving the volume, the core thesis for Destiny Tech 100 becomes clear. This is emphatically not an instrument designed for short-term swing trading.
No, it is fundamentally engineered as a multi-year hold. You are accepting the inherent volatility of the NAV premium in exchange for a targeted multi-bagger upside.
You have to ride out the waves.
It provides a highly unique utility, allowing everyday capital to gain proxy exposure to legendary, traditionally walled-off assets like Anthropic, OpenAI, and the broader space economy.
And understanding the architecture of that utility is what separates sophisticated allocation from simple speculation. Recognizing how asset-light tech moats scale and understanding the distinct mechanics of how closed-end funds are priced on the open market provides a significant analytical edge.
You are navigating a tier of the financial ecosystem that, for the better part of a century, was the exclusive playground of venture capitalists and massive institutional conglomerates.
Knowledge of these alternative structures is becoming increasingly vital. As the line between public and private wealth creation continues to blur, the investors who understand how to safely cross that line will be at a distinct advantage.
It truly represents a paradigm shift in market structure.
And that brings us to a final provocative concept for you to consider. If vehicles like Destiny Tech 100 achieve long-term success, and they successfully democratize access to the world's top 100 private unicorns, what happens to the intrinsic appeal of the traditional public stock exchange?
It's a great question.
If everyday retail investors, alongside institutions, can routinely access the highest growth technology companies years before they ever file for an IPO, it might fundamentally alter the calculus of why, or even when a tech giant ever decides to go public.
We could be watching the very definition of a public company evolve in real time. It fundamentally questions the purpose of the IPO in the modern era.
A fascinating evolution to monitor closely. Well, thank you for joining us on this talk. Keep your eyes on the filings and keep questioning the mechanics of the market.